In this video, I will explain how mortgage payments are calculated, what amortization tables are, and how Canadian and American mortgages are different. I was first licensed as a realtor way back in the 1980s, and I spent many years working as a full-time professional real estate investor. My partners and I have qualified for dozens of mortgages ourselves, and I have helped many clients through the process of obtaining a mortgage of their own. Subscribe and click the bell notification icon. Let's get started. Now, some housekeeping before we get started. I am a professional realtor and I've spent years as a full-time real estate investor, but I'm not a mortgage broker nor a real estate lawyer, so the following should not be considered financial or legal advice. In the previous video, I explained what it means to register the mortgage and the differences between a first, second, and third mortgage. If you aren't familiar with these terms, go back and watch that video after this one. In this video, I'm going to explain how mortgage payments are calculated, how interest and principal payments are divided, what amortization tables are, and the difference between Canadian and US mortgages. In most cases, mortgages are set up with required monthly payments, sometimes twice monthly or weekly payments, and occasionally other schedules. For explanation purposes, we will discuss monthly payments here, but the premise is basically the same. When you make your mortgage payment, you're paying first the interest at the rate to which you agreed on the outstanding balance of the loan, and the remainder is applied to the principal or the amount owing. The next month, the payment is made of the same amount, but the amount owing is ever so slightly less, and the interest payment is a tiny bit smaller, and the principal repayment amount is a tiny bit larger. Every month, the interest portion is just a little bit smaller, and the balance owing to be paid, or principal, is just a little bit larger. Let's work through an example. For our example, we will use a $100,000 mortgage loan with an interest rate of 5% and amortized or set for payments over 25 years or 300 months. I plug these numbers into a mortgage calculator and it spits out a payment of $581.60. Let's look at what it's calculating. Here's the first year of what is called an amortization table. So we're looking at the first 12 mortgage payments. So for the first payment of $581.60, $412.39 is interest. So there's $100,000 at 5% divided by 12, and there's your interest payment. So then you see that the amount owing is reduced, or the principal repaid, in the amount of $169.21. But if you skip down to the bottom, look at the small difference in the 12th payment. The interest paid is $404.56, and the loan amount is repaid in the amount of $177.04. So you can see that every month there's a little bit less interest paid and a little bit more of the loan repayment or principal payment. And if we follow this all the way down to the last 12 months of this mortgage loan, we can see that by this time, most of the payment is now going towards principal or loan repayment and very little towards interest. So why is that? It is because in the first year we started with $100,000 owing, but we start in the last year with just over $6,000 owing. And as we pay the interest payment first and the principal payment second, further through this process, the less interest we are paying and the more principal repayment. Now, I promised I was going to explain the difference between mortgages in the US and Canada. But before I do that, one super interesting mathematical fact. Now, although there can be a penalty charged by most lenders if mortgages are paid out early or prepayment, most will allow an annual payment towards principal, usually around 15% of the balance owing, without penalty. I went back to my mortgage calculator and made only one change. I entered a once a year payment towards principal of $1,000. It's kind of like saving about $84 a month and then plunking it down on your mortgage once a year. Now, what difference does this make? Because this goes straight towards principal, it immediately reduces the interest you pay in subsequent payments. So how much difference do you think this can really make? So if you did this every 12 months for the entire length of the mortgage, this 25-year, 300-month mortgage, this mortgage would be paid off 29 months earlier. That's like 2.5 years early. All right, now as I promised, are you curious? What is the difference between a US mortgage and a Canadian mortgage? So in Canada, interest is paid in arrears. So you get your mortgage loan, and at the end of the first month, you make your first payment and you're paying the interest for the month that has just passed. But the US is different. They pay the interest in advance. So they pay that month's interest in advance before the month passes. So what difference does this really make? So for our example loan, a 25-year loan, $100,000 balance, 5% interest, our payments were calculated at $581.60, while their US neighbors would be paying $584.59, about $2.99 a month more. Now that you understand a little bit about what a mortgage is and how they work, in future videos, I'm next going to be explaining the process of qualifying for a mortgage and other issues surrounding getting financing to buy a home. Do you have a mortgage question I haven't answered yet? Are there experiences with a mortgage or insights you'd like to share? Leave these in the comments below. I'll try to include these in future videos.